The U.S. government is running the biggest fiscal deficit outside of a war or a recession, and the 10-year Treasury yield is at the highest level in almost 20 years. Tell me why I shouldn't be concerned.
Our research suggests three things. One, if you don't like U.S. Treasuries, you tell me, and you're a bond investor, you tell me where you'd rather be. Two, economic growth this year looks like it should be strong enough that this should be manageable. Three, if the labor market weakens or inflation comes down quicker, rate cuts should come back on the table, which should put downward pressure on Treasury yields.
10-year Treasury yield rising 1% in a short period of time is really scary, but there's a good reason for it.
Everybody thought the Fed was late and needed to cut. About 2.4% worth of rate cuts were priced in the market. 1% of those were actually delivered. 0.4% are still priced in, so 1% worth of rate cuts disappeared. That pushed up the 10-year Treasury yield.
Hello and welcome to the Deep Dive by capstrat. Today we're talking fiscal sustainability. Can the U.S. Treasury continue to get away with this? Late last year, we had the view that the stock market would be looking to the bond market for permission to continue rallying. Namely, we thought if the 10-year Treasury yield got above 4.5%, that would be a sign to the equity market to pause the rally.
Yep.
So let's start with the elephant in the room, the U.S. fiscal deficit. On this chart here, a lot of negative bars. What's going on?
The U.S. fiscal deficit, we're looking at the primary deficit, interest expense, and then the expected impact over the next 10 years of extending the 2017 tax cuts, which is a pretty solid bet that that's going to happen, given the Republican sweep scenario in Congress. And what you see, as you said, a lot of negative numbers. To put these in context, we already, or even before, even without the tax cuts getting extended, we're running a fiscal deficit that's the largest it's ever been outside of a recession or a war, relative to the size of the economy, relative to GDP. So this is obviously a problem. Everybody tends to agree that this is an unsustainable path. Eventually, this is going to be a problem, or else there are going to be consequences for this. There's very little agreement on how it should be dealt with. There is some agreement on what the consequences might be if we don't deal with it. And that would be loss of our exorbitant privilege. And what is that? We're the world's reserve currency. Why? Because everyone has faith in the US dollar, that the US government is going to manage their finances to a point where if I lend it money and I get that back in 10 years, those dollars I get are going to be worth something, right? If we were to lose that privilege, you start to have countries around the world lose confidence in the value of a US dollar. The US dollar depreciates, Treasury yields start to rise dramatically. It would be catastrophic for financial markets. Nobody knows how bad it would be, but it'd probably be pretty bad. It's literally the boogeyman.
But practically speaking, right, as investors, the question for us is this going to be a problem near or medium term?
There are a few things. Three things in general that we'll run through here relatively quickly. One is, are we still the cleanest dirty shirt? Not saying our shirt is clean, okay? We just showed you the fiscal deficit. The thing is, the US bond market is extremely large, extremely liquid, and relatively safe, all right? So we have about 40% market share within the global bond market. If you were to add up the next 10 largest developed markets, they don't even total our share.
Right.
So the point is, if everybody wanted to shun the US bond market because we've lost faith in the dollar and the US government's ability to manage our finances, that money has to go somewhere. Large institutional and sovereign investors have to go somewhere. And you look at the leading candidates, like we said, they're dirty shirts as well. I mean, Japan, the Netherlands, Germany, Italy, Spain, Ireland, France, UK, Canada, Australia. I mean, not much better options out there, and certainly not as large or liquid. So the reality is our Treasury yields, because we're a dirty shirt like anybody else, they can't break away from the rest, from the other bond markets in the world by that much. Because eventually, everyone in the world is going to look at our yields and say, wow, those are pretty attractive, I'm going to buy them. Puts a lid on it. So these two lines, the blue line is the yield on the 10-year Treasury note. The green line is an average of those 10 developed markets, government bonds, bond yields that I listed previously. And there's a cap here. Our yield has only ever exceeded the average of the alternatives by 1.75%. So the fact that we're 1.4% above that average now is not concerning. What would be really concerning for us is if we broke away from the alternatives for the wrong reasons or at a bad time. The scariest situation you could think of is we go into a recession when normally money flows into the US economy, but you see the opposite. You see the dollar depreciate and you see our Treasury yields rise because there's a crisis of confidence. That's not what's happening right now, and we're pretty far off from having another bond market in the world that's large enough, liquid enough, safe enough, open enough to be a viable alternative.
Yeah.
So don't let, there is fear mongering around this topic.
Sure.
It's not a 2025 issue, that's for sure.
Yeah. Still the cleanest dirty shirt, paying borrowers more than the dirtier shirts out there.
Yeah.
I think the concern would become is if our shirt gets even dirtier, right? Where this becomes critically unsustainable. And we get to a point where we can't grow our way out of the debt. That's not even an option. So what are we looking at here?
Yeah, doing the simple math at home and thinking how sustainable is adding new debt, because the US government's going to have to add some new debt. Just think about the interest rates or the yields that treasuries are being issued at today versus the potential nominal growth of the economy, right? And right now, the average interest rate on public debt outstanding is 3.28%. That's lower than pretty much anything that would be issued today because the government's smart. They issue a lot of long-term paper, especially during COVID,
rates are low.
when rates were really low.
Yep.
Just like how mortgage rates today are at 7, but my mortgage rate is below 3 because, I got
Mine's at 2.
Exactly. So. Yours is a little better. So what would be concerning here is if they were forced to issue a lot of new debt at yields that are too high for us to grow out of in the future. And this is a legitimate concern that's going to flare up this year. It doesn't look like a concern for this fiscal year, so the first 9 calendar months of 2025. But there is a funding gap that's going to open up, especially if the 2017 tax cuts are extended, where once we get into calendar Q4 and beyond, the Treasury is going to come out. They have a quarterly process for doing this, and they're going to come out and say, we need to increase the size of auctions. We need to auction off more debt, more 2-year debt, 5-year debt, 10, 30-year debt. That last time that happened was scary, and it sent bond yields higher. So that's going to be a real concern. These are things we're paid to worry about. We're going to be watching them very closely. The Treasury has a lot of options in order to manage this risk and smooth it out. They're very creative.
Yep.
They can also just issue shorter term bills.
Yeah.
If you don't like issuing debt for 10 years at 5%, well, don't. Issue it for 3 months at 4%, try again later.
You got that nice healthy yield curve with the lower rates at the shorter end.
Exactly.
Are there other reasons for why the 10-year Treasury yield has risen? Right? Is there something we can explicitly point to and break down the math?
Reasons.
Yeah,
and there are. And it's a repricing of expectations for Fed interest rate cuts. So if you look at the market's expectations for the amount of rate cuts that they think are going to happen over the next 12 months, you go back to September, the market was thinking 2.44% worth of rate cuts over the next 12 months. Why? Because we had a couple bad labor market reports, right? Everybody thought the Fed was behind and they had to cut like crazy or else we were going to go into a recession. Well, 1% of those cuts were delivered.
Yep.
About 0.4% are still priced into the market for 2025 cuts. So that means 1% just went poof. They just went away.
Yeah. Went into the 10-year Treasury yield.
Exactly. And the 10-year Treasury yield went up coincidentally by about 1%.
Yeah.
So, this is because in September, a lot of folks thought we were going into a recession, and now they don't think that. That's a good thing. So it's very explainable and not necessarily a concerning or nefarious reason why the 10-year is up 1%. Now, if this exact same thing happened, but the 10-year was up 2% from then, that would be very concerning.
Different equation.
Yes, that's you have some more explaining to do.
Yeah. And so to kind of wrap this all up, the bottom line for us if we get to 10-year Treasury yield in the 5% neighborhood, is that a buying opportunity? Is that attractive to us? Or is that a sign that these problems are really coming to fruition?
Yeah. So think about analogs. There are two analogs. If you're afraid of the bond vigilantes, when we get later in the year and you see those ugly auctions and quarterly refunding announcements that are going to happen, you're going to think this is just like the Liz Truss government back in 2022. And so if you all recall that situation, Liz Truss came in as the prime minister in September of 2022. And she was dealing with a very unsustainable fiscal situation as well, large deficits. And she decided that her plan to take care of it was to cut taxes and increase borrowing and try to grow or inflate the UK's way out of it. And there was not a lot of confidence in that plan.
Went out with a bang.
Yeah, UK bond yields went up about 2%, and 1 month later, Liz Truss was out of a job. The bond vigilantes fired Liz Truss.
Yeah.
That's going to be brought up. We don't think that's the right analog. Much different situation here. We have exorbitant privilege. We're not the UK. They used to have that a long time ago.
Yeah.
What we think is more reasonable is what happened in fall 2023 here in the US. You had some increased auction sizes coming out of the debt ceiling debates that raged on for the first half of the year. That got a little scary. Economic growth was really hot. That was the Taylor Swift Beyonce summer. Yep. If you recall, economic growth just crushed expectations. Expectations for interest rate cuts went away, and the yield on the 10-year Treasury went up to 5%. And it was scary. And the bond vigilantes were around, and the fear mongers were out there.
Yeah.
But if you bought at that point, you would have made over 10% over the next 10 or 12 months. So it was a buying opportunity. So we think there will be some uncomfortable buying opportunities this year. We don't think this is a Liz Truss situation, not our base case, but something similar to fall 2023, that seems reasonable.
Yeah. And to kind of put a highlight on that, it kind of harkens back for me back in 2011 when the credit rating on the U.S. government was downgraded and rates on 10-year treasuries went down.
Yep.
Right? So I think that's just an example of the exorbitant privilege that we do have and are probably going to do everything we can do to keep.
Yep.
So that will do it for this edition of the Deep Dive. If you have any questions or comments, please feel free to reach out.